In this video, I'll walk through a Roth conversion example using the Tax Bracket Manager. Nothing in this video should be construed as financial advice. This is simply for educational purposes, so use at your discretion. In this example, I have a client profile built out, a taxpayer that's 64 and a spouse that is 64. And they are retiring at the end of the year. I start with the 2020 tax return. I have it pre-built out to save us time. And in 2020, they plan on retiring. Their salary will go away in 2021, so we need to adjust that fact. We will also change their fact that now they need more money out of their investment management account, so they'll have a little higher capital gains. To keep this example simple, they take the standard deduction. More complex situations do have itemized deductions and definitely impacts how the results would look. Step one is I always like to look at the tax bracket breakdown just to see how last year looked versus what next year is projected to look like. And in this situation, income is very low next year. So that's one indication that a Roth conversion might make sense. The next indication is to look at taxable income and tax brackets over time. So over the next 10 years, we can see that there's this peak and valley. And this is a common profile for someone that might want to consider Roth conversions. Seeing this dip in income, or say they're already retired and it's already low, and then this increasing tax amount over time. This is where, this is a red flag to say, hey, we have an opportunity that we're in lower tax rates, so we want to consider how can we accelerate some income into these lower rates. Maybe it makes sense to do that through a Roth conversion. Maybe it makes sense for taking out distributions earlier from a retirement account. This is just one indication that a Roth conversion might be possible or might be beneficial, and to continue to look. If it was the opposite of this, then I would question whether or not Roth conversions make sense at that point, or filling up the brackets, or what can we do to smooth them out. But the end goal is to pay less tax over time. And this is one indication that with a huge increase, if we could take out some of that money now at a lower tax rate, fill up these lower brackets, and close this little valley here, that's indication that we can add value over time. So next, to go to the Roth Conversion Analyzer tab, we have the section of how much should I convert, how much did my Roth conversion cost, how much will my RMD cost, and then what is the projected benefit of doing a single Roth conversion. So in the how much will my RMD cost, this section becomes important because in a Roth conversion planning, you need to have your benchmark. Because if you're going to convert to an IRA, or to a Roth IRA, you need to convert it at a lower tax rate now to avoid paying a higher tax rate later. So you need to create your benchmark. So step one of the benchmark might be to calculate your RMD effective tax rate. To say, hey, I have to pay tax on this IRA distribution in the future. The projected cost of that RMD is 23.76 in this example. Maybe I want to convert to a Roth IRA at a lower tax rate now, so I avoid paying that higher rate later on all of those dollars. So it's that teeter-totter example of balancing out your tax brackets and finding opportunities to take money out at a lower rate. Think back to the image of you have money in your bucket, you're emptying your bucket, it's going to go through that tax filter. How much can you keep of that? The goal is to always find opportunities to pay lower taxes when it's possible and when it makes sense. So this is one way to create that benchmark. Another way to do it is to look at the 2017 tax law. So down here, when I do the projected cost, we have that as a possible outcome. And the software calculates your projected RMD tax information when you hit that, or under the 2017 law. Why do we have this as an example? Because in 2026, we're set to sunset back to 2017 tax rates. Therefore, that's a projected tax rate increase in the future. We think back to the analogy of to change your tax, you need to change your facts. Well, this is a fact change that's in the future based on tax policy. We look back at the Roth Conversion Analyzer, having RMDs, required minimum distributions, is a change in your facts. So we need to understand our facts before we can change our tax, because we need to know, hey, what are the changes to our facts based on just how the tax policy is now? What might be tax policy changes in the future? There's a component of this that is dealing with the complete unknowability of the future. So at the end of the day, it's making a good bet. It's just, maybe at a minimum, Roth conversion planning could be just a diversification of tax brackets, or it's purely tax rate arbitrage. So in this case, it's at least a tax rate diversification to say, hey, can we take some money out now so we can avoid paying later, and diversify what the potential tax rate policies are in the future. So if we go here, we know our benchmark is at least this 23.76. So we want to consider doing a Roth conversion up to our tax bracket target that's going to cost less than this. So just intuitively, if we look at the different tax brackets, maybe the 22% bracket is going to be less than that 23.76% rate. So if we look at this, the implied tax bracket target is $173,000 to get to the top of the 22% bracket. So it says implied, there's moving parts with taxes. So in this example, it's very simple. No standard is taking the standard deduction. If there are itemized deductions, such as medical or charity that's subject to AGI limits, you might have to check this a few different times to make sure that number, as it recalculates, what it should be. So in this example, if we type in the $173,000 here, it's not going to change. That's simply because of none of those other moving parts. But if you have those itemized deductions, just take a mental note that you might have that change. So we did a 22% tax bracket target, $173,000. What is the cost of that? So it compares doing the Roth conversion versus not doing the Roth conversion by stacking that Roth conversion on top of whatever we already projected to have. We projected to have a 20.63% effective tax rate, federal tax rate. If we do a Roth conversion, it also may change your Medicare Part B premiums, which is something you can choose to take into account. We have that calculated here. By default, it assumes both taxpayers are Medicare age. Use this with caution, especially don't overvalue this part of your calculation if at some point you're probably going to be in those higher IRMA Medicare brackets anyway. That's for a different day, and also just a personal style choice. So if we just consider right now for the federal income tax, effective federal tax rate of 20.63%, we say, hey, you know what, that's lower than our benchmark of 23.76. So that makes sense to consider this as a Roth conversion amount, because it's either equal to or less than what we project to be taking out later. So we're finding that tax rate arbitrage of 3%. So if we look here, what is the projected benefit of doing this one-time Roth conversion? If we do a $173,000 conversion, we're expected to get our $173,000 back plus $9,200. That may not be a lot in some people's eyes, but that's in 10 years. So we can change this to say, what is it in 20 years? 15,000. And we can just follow this chart here to see over time what is the cost of not doing a conversion if we chose not to. So one of the factors here is that I have their profile built out, and I say, hey, there's equal rate of return for each portfolio. A standard buy and hold asset allocation typically would weight the equity portion in the different time horizon buckets. So if that's your case and you expect a higher rate of return in a Roth, because the Roth is the furthest away from ever being touched, then you may want to have a higher projected rate. The rates I'm using are just for simplicity. It's a personal choice of what rates you would like to use. And so if we said when all those buckets are equally expected to have an equal rate of return, we have an expected value add of 15,000 from just doing this conversion in 20 years. But if we add just 1%, it has a huge impact on where we're at. So effectively in 20 years, it's not too far from doubling the value of that 173,000. So the key to remember is that this is the same $173,000. You're just choosing to pay less tax on it and possibly investing it more aggressively for a higher rate of return. Now here, other factors to consider. If you're in a no tax state now or a tax state now and going to a no tax state, those should be reflected here. Or if you're just going from a higher income state to a lower and vice versa, that should be reflected here. Or maybe you really want to use that 2017 tax law as your benchmark, which is 4% higher. So all of a sudden, now the value of that Roth conversion goes up a lot. And as you see over time, the bigger the gap in this, in the different tax rate differential, the more there will be, the bigger gap between the growth rates, that matters too. So overall, this is how I approach Roth conversions to get an idea of, hey, is it really worth me paying the tax today on this conversion? Because if you look back here to the tax bracket manager tab, all of a sudden they have a $173,000 conversion. They're going to owe a substantial amount of tax. So paying that tax, that's the worst part of this whole thing. Get to April, have to write that check. Why am I writing that again? Oh yeah, because in the future, I expect that this same money, this same $173,000 is going to come out and I'm going to pay a lot more on it. So it's all about finding those imbalances, finding opportunities to convert at a lower rate. This is just one example of how to do it. There's depth to each of these areas. It's personal preference. It's the tolerance for how tax policy changes will be in the future. You don't have to go all the way up to the bracket when you do the conversion, that $173,000. Here, if we see $173,000 conversion gets us to a modified adjusted gross income of $239,000, which is just a little bit above where this second tier of Medicare premiums is. So maybe your real Roth conversion you want to consider to be, let's just say 20,000 less, just to keep it simple, 153,000. And now all of a sudden that federal tax rate's even lower, and maybe that's more in line with what your goals are, because maybe paying that extra Medicare premium each year is not ideal. It's something that you need to remind yourself that you're going to have to pay that higher premium if you do Roth conversions and you're in these lower tax brackets now. But the idea is maybe you're going to be paying it in a few years anyway, so it's all about the balance. So understanding when you're making your benchmark, what is my benchmark? What is the cost of my conversion? Am I converting it lower than my benchmark? If you feel confident there, you'll feel a lot better about doing the conversion and paying the tax. So when you're writing that $30,000 check in April, if you didn't make estimated tax payments, then you're going to feel a lot better about it, knowing that, hey, I'm doing this because I believe and understand and see why there's value to doing this conversion. So there's more to all this. Play around with it, get comfortable with it, reach out with questions. That's all I had on how I look at Roth conversions for today, though. Thank you.